Dima, you there? Thanks for joining us today, everyone. How you doing, Dima?
Good morning, Will. Good morning, everybody. How's your weekend, Will?
It was great. I'm exhausted, and it's cold now in Philadelphia. I don't know if you noticed.
Yeah, it's getting chilly for sure.
Yep. Well, thanks for joining us, everyone, for our first morning show of the week. We'll start right with the disclaimer. What do you think, Dima?
Yep. Good morning, everybody. Thanks for joining us. Before we start, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for. They should be able to answer your questions, provide you with guidance. There's the disclaimer, everyone. And with that,
awesome. We do have a lot of people on the chat this morning, D. Some new people. Remember, any questions, please put them in the chat, and we try to get to as many of them as we can. If we miss it, it doesn't mean it's not important. Please put it in the forum, and I'll put a link to the forum right away. All right, with that, Dima, let's get this started.
Okay, and let me take a look. I did see some people popping up a few symbols here. I have it to my side. So I'm going to try to go over some of these symbols that people are putting up, like Twitter, Tesla, Twilio, and we'll really quickly look what's going on in the pre-market hours. We've got a bunch of earnings coming up, so I'll spend a little bit more time on what's coming up in the earnings, how the options are lining up. I also want to take a look at one of the screeners we started last week with the repeat option order screener. We'll also leave some room for that. Take a look there. And of course, if there are any questions along the way, let me know. I'll stop and try to answer some of the questions. So this is the pre-market report, stocks that are trading actively in the pre-market hours. We got the most active stocks, biggest percentage gainers, biggest percentage decliners prior to the market open. Really quickly, I'm going to take a look. I'm going to filter this report for stocks that are in a higher market cap stocks. So I'm going to use this filter over here, market cap. Let's take a look at stocks that are at least 20 billion market cap or higher. I filtered that out. Looks here, 5 of them made it on the percentage gainers list, 54 on the percentage decliners list. So at least from the market breadth perspective, looks like we're setting up for a weaker opening, weaker on a day. Nothing huge pops out at me on the biggest percentage gainers list. Here we see SAP, that's down 21%. There's some news there. So didn't see that before. Oracle down 3.2%. I'm going to come back to the unfiltered list really quickly, see what's going on in general. And I see LLIT up 65%. That's a low cap market cap stock. Looks like they had some news on there. A merger agreement. DSS, Dunkin', that's Dunkin' Donuts, right? DNKN. I think their takeover rumor or takeover news on there. That's up 18% in the pre-market hours. Just to leave more room, unless there's questions, unless you have questions on the pre-market report, Will, I'm going to jump to some of the symbols people have been posting and then get to the earnings report.
Sounds good, buddy.
We don't have anything yet. Let me just take a look real quick, some of them that were popping up. So yeah, I'm just going up in so a couple of them in the beginning. I see it like Tesla, Twitter, FSLY, SQ. So let's just take a look. Maybe we'll start with Tesla and Twitter. We got that report. So people have been asking about Tesla and how that's been doing. So they reported earnings last week. It looks like they did report some. It was, in general, I think it was a pretty good report, but there was a lot already built into that stock. Obviously, it's been going up for a while now. It popped up a little bit. Now it's drifting lower with the rest of the market. I'm going to take a look at just how the option order flows. So this is the option order flow sentiment over here. And this is just going to take a look at how traders, how they've been buying bullish calls versus bearish puts, and how that's trend is changing over time. So here in Tesla, we see in the last 30 days, we see about 200 on average, $208 million worth of bullish calls purchased versus $81 million worth of bearish puts purchased. So a 72% in favor of the bullish call purchases versus 28% bearish puts. So this is looking at straight, call purchases. So single-legged call options trades that are on the offer with the belief that those are incoming buy orders versus bearish put options, where it's looking at single-legged options trades on the offer and the puts. So here we got, in the last 30 days, this is what it looks like: 208 million on average versus 81 million in bearish puts. We see in the last 5 days, it's still more bullish call buying than bearish put, but that trend is slowing down. So now we got, in the last 5 days, about $112 million worth of bullish call buying versus $55 million in bearish put buying. So you see here 67% versus 33%. And then the last day on Friday, it's coming closer to even, $94 million worth of bullish call buying versus $70 million worth of bearish put buying, 57% to 43%. So kind of just shows a little bit of that enthusiasm that we've been seeing is slowing down, or that trend, is slowing down, coming back a little bit towards more even in Tesla. Let me jump to Twitter. I think Twitter is coming up with earnings. So here's Twitter, and that's expected to release earnings October 29th before the market opens. And let's take a look what Twitter's been doing in between earnings. So I'm going to take a look at its post-earnings drift. I know that they've been hitting new 52-week highs. So let's see how far away it's gotten after reporting its last earnings announcement. So this is the post-earnings drift report for Twitter. So we see here that Twitter is up 31%, 31.2% after reporting earnings. It's drifted another 31.2%. That compares to its average drift of 7.3%. And here we see that a standard deviation move between earnings is 13.7%. So we're about 2.3% move when we compare it to standard deviation. So that's a pretty big move for Twitter. Very optimistic coming into before their earnings. And I'm going to take a look at that history here. So here we are right here today. From the previous earnings, up 31.2%. The drift from the last earnings to the high, 31.4%, to the low, 7.3%. So we're right up there near that high. That compares to a historical average, a drift of 19% to the high and negative 13% to the low. And here we see, this is the history. I don't know if you see down here, this table. So we could see here where a lot of enthusiasm, like the previous one, the drift between earnings was plus 28%. So it must, it gave a good report. It was up 4%. So the idea here is, if a lot of enthusiasm is built already to the upside, there might be less, unless they really blow out their earnings, there might be less room or upside surprise because it's built in. And if it's not so good, the magnitude to the move to the downside could be pretty big, right? Because we have already got a really big price, enthusiastic pricing into the upside. So here we see last earnings up 28% between earnings. They reported the stock was up 4%. Previously to that, the drift was negative 19%. They reported earnings, it was bad. The stock was down 7.8%. So you see when the moves were a little bit more muted between earnings, 8.6%. Then after reporting earnings, obviously they have a lot more room to move. Up 15% here, down 20% here. Does that make sense, Will?
Yeah.
We'll see. So right now, I think the risk is more since we priced in a very large upside move, right? It already gained 31% since reporting last. So that risk, we'll see what they say, but you know, if it's not so good, there might be potentially a big downside risk there in Twitter. Let's take a look at another report.
We had some questions in PayPal. I don't know if you want to look at that. Snap was some questions in Snap.
All right, so let's take a look at PayPal here. That's coming up with earnings November 2nd. I'm already on this report, so let's see what it's done since its last reported earnings. So that has drifted up 5.5% since it last reported earnings. On average, it drifts 8.7%, standard deviation 6.2%. So that's kind of like in line with what it's been doing. It hasn't like broken out of that, expected range. What was the other one?
Well, in PayPal, he had bought some straight puts like a week ago. Maybe if he was obviously bullish. Maybe if you could show him what a bull put spread, a credit put spread, if there were any ideas in the trade ideas.
So he bought puts?
No, he bought straight calls.
Oh, straight calls. Okay.
I was just wanted to see if there were any ideas. If you look at bull puts, like a credit put spread, a bullish credit put spread, show it how it shows up in the trade cards, that type of thing.
Okay. So in the trade ideas, here's some bull put spreads that popped up. Here we see in November 20th expiration, selling the 197 put, buying the 192.5 put. That's a credit of $1.75 right now, compared to what we think it's worth theoretical value of 55 cents. That gives you a theoretical edge of 36.9% with a historical win rate of 90%. Here's another one. This is also November 20th, selling the 200 put, buying the 195 put. Sorry, that's a call spread. This is a call. You just want to look at put spreads, or?
I was just thinking if you were bullish. I mean, I prefer to take in a credit, but the key thing with the spreads is you completely, your max loss, right? That's the big thing. And you do with an option as well, just buying a call as well. But there are other ways to look at, bullish ideas other than a straight call purchase.
Right. And in the call spread, you can structure it to increase your odds of success, your probability of success, and actually probably gain a little bit more edge. Of course, when you're just buying a straight call, you have that unlimited potential gain, but the likelihood of something like going to infinity is like very low. But yeah, you're using bull put spreads or call spreads to increase your probability of success, gaining more edge. So here's a call spread here. You're buying November 20th, the 195 call, selling the 200 call in the same expiration, November 20th. That'll cost you $3.15. We think it's theoretically worth $4.19. So that's a edge of 33% and a historical win rate of 80%. Here's one more. Oops. This is looking at also November 20th expiration, buying the 197.5 call, selling the 202.5 call. That is, you would be paying $2.90. We think it's worth $3.77. So that's a theoretical edge of 30% with a historical win rate of 75%. So that's one put spread, two call spreads here.
Cool.
One way to play a bullish play. Let's take a look at what's coming up in the earnings front. Unless I missed some symbol. I mean, I know I'm getting a bunch of symbols
Well,
Now,
and I think we mentioned TWLO Earnings is coming up. Someone, I think it was Mike from Naples, was asking about TWLO, and I know that earnings
okay,
may be coming up.
so we'll take a look at TWLO, and we'll take a look at other ones that are coming up, and then I'll go to TWLO, and just take a look for that specific stock. So let's take a look at stocks that are expected to report earnings in the next 2 weeks. So I switched to this tab, and I'm also filtering stocks that on average trade 5,000 contracts or more per day. And here we have CHGG that's expected to report today after the market close. The straddle is implying a move of 15.9% in either direction. So that's looking at the magnitude of the move, buying a call, buying a put. That compares to a 4-quarter average move of 13.9% and a 12-quarter average move of 11%. So we see currently priced 2% above that 4-quarter average, 4.9% above the 12-quarter average. The high move on that stock in the last 12 quarters was 32.3%. AGNC, that's also expected today after the market close. The straddle from Friday's close is expected to move of 3.2% in either direction. That compares to a 4-quarter average move of 1.9% and a 12-quarter average move of 1.6%, with a high move on that stock of 4.2% in the last 12 quarters. NXPI, same thing. Today after the market close, as of Friday's close, the straddle was implying a move of 5.1% in either direction. That compares to a 4-quarter average move of 3.6% and a 12-quarter average move of 4.5%. A high move on that is 12.1% in the last 12 quarters. Here's Twilio, and I'll go to Twilio after this. Same thing today after the market close. Based on Friday's straddle, it was implying a move of 8.9% in either direction. That compares to a 4-quarter average move of 14.8% and a 12-quarter average move of 14.1%, with a high move on that of 39.6% in the last 12 quarters. And you could see here, even the implied move right now of 8.9%, we see that it's below the actual moves last 4 quarters and 12 quarters, and it's also below what the options typically imply right before the earnings. In the last 4 quarters, on average, the implied moves were 9.5%. In the last 12 quarters, the straddles on average were priced for an 11% move. So let's take a look at TWLO.
Hey, D, Mike's looking at one put spread in particular. Can you put it into the options chain and see what it's showing when you get a chance?
All right, what, in TWLO?
In TWLO, yep.
All right, so let's take a look first at the history, and then I'll go to the options chain. So we see here, I'm just looking at just visually at this chart. So these bars over here, if you guys haven't seen it before, this is what the options were implying to move in either direction, so up or down. So you're buying a straddle, doesn't matter in which direction it moves, it's just looking at the magnitude of the move. So the one I'm hovering over right now, this was August 4th. After the market closed, they reported earnings. The stock was down -2%. That's what that red bar is. The implied move was 9.5% in either direction. This bar over here on May 6th, we see that the actual move was 39.6% versus the implied move of 9.2%. So see, especially to the upside, we see that it really breaks up to the upside, like way above like where those implied moves were anticipating. And just looking at this bar over here, it's kind of looking in line a little bit less than it was priced historically. Here are the stats. Twilio, 50% of the time, the straddle overestimated the move. 50% of the time, it underestimated the move. On average, the options were predicting a move of 11% up or down in either direction, compared to historical average actual moves of 14.1%. So we see here, at least historically from the long straddle side, it was a winner 56% of the time for an average return of 33%. So really kind of the opposite of what we usually see, where the straddles tend to be priced, priced higher than the actual moves. Let me take a look at just what the implied volatility did after earnings, and then I'll take a look at that spread that you were talking about.
Cool.
So here we see when we're looking at the 30-day option, so we're not looking at the near-term option, but something with a little bit higher vega, so 30-day constant maturity. On average, the day after earnings, that implied volatility declined by 25%. So that's the average implied volatility crush. The 1 day before reporting earnings, on average, the implied volatility was 64.3%. So a little bit kind of close to where we are today. On average, the day after reporting earnings, the implied volatility declined to 48.2. 5 days later, the implied volatility was 46.1, so it decreased a little bit further. Let me take a, so you had a specific option.
Yeah, Mike was looking at I think it's expiring. Let me see, Mike. It was all right. This is the TWLO, right? The TWLO put spread, the 307.5 versus the 305s, OC 30 puts.
So, okay, so I'm going to go to the October 30th expiration, which obviously that's going to cover earnings because it's today. And so we're on the options chain here. Here's the put side if you guys are new to the options chain. And which put spread was it again?
He's looking at the 307 spot 5, 307.50.
Okay.
Versus the 305s. So right around at the money, I guess.
Okay. So, and he's selling the put spread?
He says 140 premium, so I'm assuming he's buying it.
He's buying it?
Well, it says 140 premium, so either he's
okay. I think he was saying from a bullish side, right? So 307.5. So here I'm going to take a look at this. So if we're selling the 307.5 put, I'm clicking over here on the bid side, and this pops up: sell October 30 put 307.5, 1425. That's the bid price. The 305 put, I'm going to buy that put to complete that credit put spread. So buying the October 30 put 305 strike for 330. I'm going to load that strategy. So you could see what that looks like at expiration. So we get a 95-cent credit here. Keep in mind, this is a very wide market. So the midpoint here is $1.48, which is, if you hit that bid, 95 cents, that's really far away. So when you guys are doing that spread, pay attention to that bid ask spread, because here we could see it's very wide, 95 cents.
Yeah, well, he was talking about trying to do it at $1.40. So
all right, so even $1.40 is not so bad, compared to how wide this is. But obviously, you hit this at 95 cents. That's more than 50 cents away. That's like 2/3 of your, the premium right there. So pay attention to that, everyone. How far away you're doing it from the midpoint, $1.48. This is what it looks like at expiration. So you see here in the green, that's where it would be profitable to the upside. To the downside, that's in the red. So you're stopped out to the downside. If you do it at these prices, losing $1.55. If you do it at these prices, obviously you're making 95 cents. That's your credit. Let's compare this to, let's take a look at the last 12 moves on earnings. So what I'm going to do here is plot the percentage moves in the last 12 quarters to see where they land on this line. Okay, so last 12 moves. So we see here that, a lot of them, I would say about half of them were, maybe even less than half, were in this green section here. We see, in this red section, that's to the downside. So that's what it looks like, a distribution of returns on earnings. So that's plotting it that way. Let me take a look at the historical. So I'm going to take a look at the theoretical value historically. Let's take a look at last 6 years. I'm only going to look at earnings periods. So based on that, in the last 6 years, only doing it around earnings on average, then value of the spread at expiration was $1.32. So obviously, if you're doing it at 95 cents, that's not enough, compared to the historical averages. Even at $1.40, looks like, not a great amount of edge, but got about a 50-50 there. So that's what I see from this particular spread, if you're holding it to expiration through earnings. Is that helpful?
Yeah, that's great.
Okay.
We had one last, I guess Microsoft is earnings this week. One last, I haven't seen his name before, so he asked. I thought we'd try to get a quick look at the Microsoft earnings.
Okay. Let's take a look at Microsoft here. Just move my all right, so Microsoft. So this is what the chart looks like, the implied move versus the actual moves. And looks to me like most of the time it was kind of like within. We see here, it broke out October 26th. After market close, it was up 6.4% compared to the expected move of 3.4%. But this is what the historical averages look like. So 92% of the time, the straddle overestimated the move. On average, the implied moves coming prior to reporting earnings was 4.2% in either direction, compared to an actual average move of 2.7%. So we see there about a 1.5% differential between the implied and realized moves. Let's take a look at what the implied volatility did. So on average, the implied volatility on a 30-day option, so 30-day constant maturity, that was down 24% day after reporting earnings. So day before earnings, average implied volatility on a 30-day was 28.3. Day after, the average implied volatility was 21.5. 5 days later, it was 22. Let's see, today you see it's about 36%, so above that average. So we're like right here. Well, we're still 3 days away. So 3 days away, 28.3 average. We're right here at 36.1. So that's on the higher end. Let me take a look what Microsoft did since its last earnings. So we see that Microsoft has drifted up 6.8% since it last reported earnings. That compares to a historical average of 7.5%, so within range. And we see that that's 0.9 standard deviations, a 0.9 standard deviation move. So it is within that range. Obviously, it's to the upside, but it is within the range that we expect it to move in between earnings. Any other ones, Will? I didn't
got a real quick question on Square, if you have time, SQ.
Okay.
No real question. They're just asking SQ.
SQ. I mean, they're coming up also with earnings November 5th. We could take a look at it really quickly. We only have 2 minutes left. I didn't get to the repeat order screener, so
we'll have to do that tomorrow. And we have a webinar tonight, everyone. Just to FYI, 6 p.m.
So here's what Square looks like historically going into earnings. Here, let's take a look at the historical averages. So 69% of the time, the straddle overestimated the move. On average, the move prior to earnings, the anticipated move on average was 8.7% compared to the historical actual average move of 5.9%. So we got there like what, a 2.8% differential between expected and realized move. Let's take a look at the implied volatility. So historically, the implied volatility day after earnings was down 20%. One day before earnings, the average implied vol was 56.3 on a 30-day constant maturity, compared to the day after reporting earnings, the average implied volatility was 44.9. 5 days later, the average implied volatility was 45. So that's really quickly SQ. And maybe, you know what I'll do next is what tomorrow remind me, let's set up a time spread, because we usually look at it from the perspective of just straddles. I think it would be good to show people how a time spread around earnings.
All right. I'll write that down. We're also having a request from Mike H. Repeat the order screener tomorrow. He's super helpful. All right, everyone.
Yep.
Awesome job today, Dima. We do have a webinar tonight with Felix Frey at 6 p.m. Please join us for that. Dima, great job.
All right. Thanks, everybody. Have a great trading day. Hope to see you guys later tonight and tomorrow morning.
Stay safe out there. And if you're new, I know there were a bunch of new people on. Make sure you subscribe to the YouTube channel. Super important. You'll get alerts